right, guys. Well, thank you for having me today. I appreciate it. My name is, I introduced myself when I came in, but my name is Ted Lanzaro, and I'm a CPA specifically for the real estate industry. So probably 90% of my clients are either landlords or rehabbers, commercial building owners, shopping center owners, office buildings, that sort of thing. And what I do is I have a very kind of a proactive approach that I take with them, which is pretty much planning based. And we try to save them as opposed to like what an ordinary regular CPA would do, which is probably more in tune with, here's my stuff, slap it on a form. We're kind of involved in everyone's business, and we talk to people when they're, a number of occasions during the year, which is, when they're buying a property, when they're selling a property, when they're fixing up a property, and, kind of this time of the year, towards the end of the year, to do some planning before year end, because most of the good tax strategies have to be implemented before the end of the year, not after December 31st. So are all you guys real estate professionals? Mortgage, okay. So for you guys that are, so there's essentially three classifications of investors. And for example, your landlords, Dave, that you manage the properties for, are probably considered passive investors because you're doing the management for them, right? So a passive investor is somebody who's either not managing their own properties or they're investing in somebody else's deal. So they could be like somebody who's investing in a syndication kind of a deal. Or they're anybody who, even if they're actively managing their properties, they're earning over $150,000 a year. Because the IRS tax code says if you make over $150,000 a year, then even if you're an active investor, actively managing your own rental properties, then you're still phased out of taking rental losses against your ordinary income. So in this case, you'd be phased out, say, for example, from taking rental losses against your mortgage company earnings or your real estate commissions or your property management business earnings. So if you're investing passively, the best you ever can do is to get to zero, okay? And that's the whole idea of why people invest in passively in real estate is if I'm invested, say, in a syndication or if I own a rental property, even if I make that kind of money, I want to get that cash flow, okay, into my pocket and still have the taxable income be zero or lower due to the depreciation on the property. And the way that works typically is that you would take the cost basis of the property, whatever you paid for it, okay, and you deduct that over periods of time. For residential properties, that period of time is 27 and a half years. For commercial properties, it's 39 years. And then we'll talk a little bit more about ways to accelerate depreciation. And anytime you guys have any questions, by the way, just, have at it, ask. The second category is active investors, okay? Those investors are people who are actively managing their own properties. And what the IRS says is if you're actively managing your own rental properties and you make below $150,000 a year, you can deduct up to $25,000 a year of rental losses against your ordinary income. So if I make $100,000 a year in my business and I have these rental properties and my depreciation on my properties gives me, even if I'm making money, the depreciation might give me a $25,000 loss, I can offset that against my $100,000 of earned income and only pay tax on $75,000 of earned income. So it's a big advantage. Now, if you're a real estate professional, and the IRS defines real estate professional as somebody who spends over 750 hours in a real estate related trade or business. So that might be agent, broker, property manager, developer, rehabber, professional landlord. Okay, so people who all they do is landlord can be considered real estate professionals. Unfortunately, the mortgage business doesn't qualify you for that, but the people who spend over 750 hours, and it's more than half of what they do, okay? So you could, in theory, have, so somebody who has a full-time job outside of real estate, but also owns properties would have a very hard time qualifying as a professional, even if they spent over 750 hours a year managing their properties, because they'd have to have over 2,000 hours of total hours in order to get over the 50% hurdle. So there was this lady, a few years ago who called me, and I knew she had a full-time job down in Stanford. She was like an IT lady, and she says, I'm a real estate professional. You're going to show me as a real estate professional this year. I've got a lot of losses, and I want to take them against my ordinary income. And I said, well, I really don't think that you qualify. You spend 2,000 hours down at your job at Stanford. Ted, I work all the time. I work 2,000 more hours just doing my real estate. I'm an agent. I do this, I do that. I don't even sleep, right? So I said, well, honestly, I don't think you qualify, and I don't want to see you get in trouble, so I'm not going to file your return that way, And she's like, well, I don't agree. You're fired. And she left the office, right? And a couple of years later, the phone rings, and it's her on the line, and she's like, Ted, I got this letter from the IRS in New Haven, and they would like me to come down to their office and discuss my real estate professional status for, 2015. And she's like, can you help with that? And I said, well, in 2016, when you were in my office, I told you that was a bad idea, and so it's still a bad idea. I don't have any defense, to go into the IRS and explain it, right? So I said, you don't really need an accountant at this point. You need like a magician or an attorney or somebody, but not me. David Copperfield maybe could help you, but, not me. I said, I would just pay the fee, pay the fine, pay the taxes, pay the penalty. You were wrong, okay, but that's the kind of thing that you kind of get into. Now, it's a huge advantage, say, for somebody like you, right? Because you go out, you can offset, you can get your rental properties, and even if you're making money on your rental properties, the depreciation creates a loss, and you offset that against your ordinary income, and you pay less taxes. It's a great advantage. It becomes even better when you use some of the strategies that you can use for accelerating depreciation on your rental properties. Okay, we talk about this in the book, but so there's this thing called cost segregation, and this is, by the way, this is if you're out selling properties to investors. These are good things to know, because you're going to be able to tell them, maybe why a property makes a little more sense than maybe the original analysis did, right? Because, hey, well, wait a second, there is a big tax break because you're going to buy the property and you're going to cost segregate it. And so what we do with cost segregation is on larger properties, it's literally an engineering study. So a CPA and an engineer and an appraiser get together, and they go out to, an office building or a big apartment building, and they literally walk through it, and they literally make a list of every component that's in the building, and then the appraiser will say, okay, you bought this building for $2 million. We're going to now allocate out all of that $2 million to every cabinet, light, floor, wall, right? And it's a big process. And these studies cost maybe, $8,000 or $10,000, $12,000 depending on the size of the building. But on a $2 million building, you can usually allocate about 25% of the cost basis to five-year assets. And a 5-year asset is, the IRS classifies a 5-year asset as anything I can unscrew and walk away with, right? So if you just look around the room, I could probably unscrew those, cabinets off the wall. I can take that microwave with me. I can take the sink out, the refrigerator, all of the lighting, probably, other things. All of those things are 5-year assets, right? The doors. So when I go and I allocate all of those things, especially in an apartment building or a commercial property, I'm going to come up with quite a bit of money. And I'll just give you an example. We just recently did a $1 million apartment building in St. Louis, where $220,000 of the building was considered a 5-year asset. Now, the guy who owns that building, right, is going to get first-year depreciation of $220,000, literally, of those 5-year assets, because the IRS has a law this year that says you can take 100% what's called bonus depreciation in year one of any 5-year assets, right? And the same thing with 15-year assets. 15-year assets are land improvement, so fencing, sidewalks that lead up to the house, retaining walls, sidewalks, all of the various landscaping, right? So same thing. So they identified another like $30,000 or $40,000 of that. So this guy's going to get like a $270,000 deduction on his return. Now, he can't take all of that against his ordinary income. In fact, he doesn't even have that much ordinary income to offset, right? So he made $100,000 in his real estate related, in his real estate professional business, and he's got a $270,000 first year loss. He's gonna pay zero income this year. And if he makes the same thing next year, he's going to pay zero income the following year. And if he makes the same thing the following year, he's going to pay, $30,000 on taxes because he's going to offset his 100 plus his 100 plus his 70 of his 100 in the third year. So, I mean, he's not going to pay taxes for 3 years, but he's going to make his 100 grand every year, and he's going to make cash flow on the rental property. So this is all deferred money. So it's really, I mean, it's a great scenario for somebody like that. You can do the same thought process with a 3-family, right? You're just not going to get an engineering firm to come out and look at a 3-family. So what I do with clients is I have a little kit that I developed, and it's basically just an ebook that says, here's how you do this, right? And so walk through the inside of the property, list out all of the componentry, right? And if it's a 3-family house, it's going to have 3 kitchens. It's going to have at least 3 bathrooms, hopefully, right? And, it's going to, there's going to be other things in there, and you're going to list all of this stuff out. And then you're going to price it out. As long as you're going to take pictures of it, right? So this is the sort of the process that's outlined in the little ebook. And then I give them a spreadsheet. And we just go through the spreadsheet, of all the various components they came up with, and then there's just a pricing model there. We got a refrigerator, right? Okay, well, how much would that refrigerator cost at Home Depot, today? Oh, $1,000? Okay, well, what condition is it in? If it's in really good condition, then maybe you can allocate $700 or $800 of the purchase price of the property to it. If it's in really bad condition, maybe you only allocate $100. If it's somewhere in the middle, maybe it's $300 or $400, right? Don't be a pig, right? Just do what you can with it. But the idea is, if I do a little here and a little there, when I'm all done allocating out all the stuff in that apartment, I'm going to come up with probably $8,000 or $10,000 worth of stuff. Great, maybe even more, right? Typically, you probably pull about 20% out. So when you do that, now if you've been conservative, even without the study, now you still get that tax deduction. Your client maybe still gets that tax deduction for that $10,000, $20,000, $30,000 that we've identified, right? And we've documented it. And that's the big key, is the documentation. You don't want to have a client do this. Go ahead.
Can somebody do that on a property where it's never been done before? Like, can you go back and do it, or is that just in the first?
Yeah. So what I'm typically talking about, what I'm talking about right this second is, hey, I just bought the property, yeah, right? But let's say I've owned the property for a while, right? Well, so let's say it's year 4. So you can do a retroactive study, right? So the retroactive study would be, hey, I bought this 4 years ago. I paid $200,000 for it. Now I'm going to go back and I'm going to do this process, right? Now let's say I come up with $30,000 of stuff, right, in that process. The only difference now is I have to file a special form with the IRS that says I'm changing my accounting method, okay? And I'm choosing to accelerate the depreciation on my 5-year assets. And then it comes with a little bit of a calculation, because think about this. I've already depreciated some of that over the first 4 years, right? But here's the thing. Let's say I've allocated, I find $30,000 worth of stuff, and I know I've taken $1,000 of depreciation against this $30,000. So now my cost is $29,000, right? But if I had done it as a 5-year asset to start with, I would already have 4/5 of that $30,000 depreciated. So 4/5 of $30,000 is like what, like 24, right? Okay, so now I can take the difference in the year that I do the retroactive study, I can now take the difference as depreciation that year. So I can catch it up as if it was a 5-year asset all along, and I can take that deduction all in 1 year. So it's actually pretty awesome. Now, the only time you don't want to do that is if it's already over 5 years old, right? Because if it's already over 5 years old, then it's harder to do that catch up, you know.
As long as you're doing it in the first.
As long as you're doing it in the first few years, right? The other thing is think about, and I don't know how much if any of you guys do any commercial stuff, but if you have a tenant that comes in, say you're leasing, you have the listing on a building, and the tenant comes in and is going to make all kinds of changes to the interior, and let's say the landlord is actually going to fund that, right? Well, and you can do cross segregation on that also. So all of that leasehold improvement, which would ordinarily be considered, well, in a commercial building would be considered 39-year property. Well, a lot of that stuff is probably 5-year property. So if the landlord's paying for it, you tell the landlord, hey, you need to cross segregate that stuff. That'll help you, right? And if you're the tenant's agent and the tenant's going to pay for it, like let's say the tenant leases this space and they go to put a restaurant in there, right? Well, restaurants have shitloads of 5-year property, so there's going to be all of the kitchen stuff, all the chairs and tables, all of not only the kitchen stuff, but all of the stuff that feeds the kitchen, the electric, the gas, the hood stuff, and all that kind of stuff. All of that is 5-year assets. So when somebody's doing something like that, a restaurant or a dental office or a doctor's office or anything with a lot of like sinks and counters and whatever, it's really a great strategy for those people to do one of these asset breakout studies. Typically with those kind of folks, you do want to get the engineering study done because you want it to be as bulletproof as possible. And typically they're spending a few $100,000 or more, so it's worth it, the tax advantage. So, and the way that we always do this is I'll go out, I have 3 or 4 companies that I use, and say the client wants to get a study done, I'll actually shop the study for them. I'll get some specific information about the building or the space or whatever, and I send it out to 4, like you guys would do bids, right? I send it out to bid, and we get back first an analysis of what we think we can pull out. So it's going to be, hey, you spent $1 million. We already know we can reclass $200,000 of that, and that would probably at 20% that'll save you 40 grand in your taxes, right? And then the price of the service is $6,000. So you say, okay, well look here, we got 4 quotes, they're all around $6,000. We know you're gonna save 40 grand in taxes. Look, this looks like a pretty good deal, right? You should do this, and then sometimes it comes back and it doesn't work. Sometimes the margins are a little thinner or whatever, but typically it's kind of a good process for any of those kind of like larger building owners, shopping centers, office buildings, larger apartment buildings. It's always pretty much a no-brainer at that point.
So is that what they're talking about now when they're saying sort of like the depreciation is kind of gone away? Is that you can accelerate? Is that kind of what like that shorthand is? Because they started talking about this recently that you don't depreciate anymore. So an example would be it used to be if you put in one window that's an expense. If you put in all new windows in your house, that's a depreciating asset, or
right.
In a multifamily. So is that what they're talking about now with the sort of depreciation is gone? Is that you can accelerate everything for the 5 years?
Well, there's two scenarios there. So one, yes, there's this bonus depreciation that says you can take all of this stuff in year 1. But the IRS also, a couple of years ago, basically revised all of the repair versus improvement rules. Okay, so they came back and they said, look, there's certain things that we're always going to classify as repairs, right? So one of the things is replacing HVAC units. You don't have to, they don't have to be capitalized anymore, right? So if even if it's a full gut, pull it out, right? So replacing of heating and cooling systems is always a repair now, doesn't matter. and actually you can get like a double bump on it, because let's say you had one that is not fully depreciated, right? Well, now I can take the full depreciation on that one in the year I abandon it, I get rid of it, and I can expense the new one as a repair. Okay, so that kind of gets interesting, and there's a whole list of those, and the list is in the book, of everything that's generally considered a repair now, and it's pretty cool. So the way the IRS defines repair is that if it brings something back to operating condition, it's a repair. If it improves the operating condition or makes new the operating condition, then it's considered an improvement, except for all of these things that we've already told you we specifically exempt and are always repairs, right? So nothing's ever easy, right? So that's where it gets really cool. And so there's actually, so when I say I want people to call me when they're renovating a property, right? There's actually a strategic way to renovate properties to sort of take maximum advantage of this, right? And there's also a way of documenting it, that you want your contractor to write their bill a certain way so that they break out. So if you know, typically, like if you have a scope of work on a property that you're doing, right, you can sort of pre-identify. Like I can look at the scope of, look, I was in the rehab business for quite a while, and when I was in the rehab business, every deal we did, we wrote a scope of work. So when we handed our contractor, when we said rehab this house, he didn't just figure it out. He had specific things that he was going to do, down to like literally detail. This is everything you're going to do in this room. These are the materials you're going to use. This is the color paint you're going to use, blah, 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 right? So if you've got a scope of work like that for a building, that you're managing or need to redo or whatever, well, we can look at that scope of work. I mean, I may be one of the few accountants who actually can do this, but I can look at the scope of work and say, repair, 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 improvement, whatever, right? And then sometimes you'll look at it and say, well, wait a second, do we want to call that an improvement? Is that going to be an improvement that's a 5-year improvement? Or is that going to be an improvement that's a 39 or 27-year improvement? And if it is going to be a 39 or a 27, how do we try to justify it? Or how do we try to maybe mitigate that, right? So let's say, just as an example, this floor is a little broken. Maybe there's a couple of pieces of material there that's damaged, right? And you had on your scope of work, hey, we're going to replace the whole floor, right? And I know you probably don't do this, but the thought process is, well, if I just repair that one spot, if I can do that, then it's a repair. If I have to pull the whole floor up and replace it, now it's an improvement. So when I look at that and see that on a scope of work, maybe I'm going to make a suggestion. Hey, well, have you thought about just doing that one spot, or have you thought about not upgrading the material? Because if you upgrade materials, right, then it's always an improvement. So if I take a laminate floor and I put hardwood over it, I've got an improvement. If I replace a laminate countertop with a granite countertop, it's an improvement. Right, so automatically, because I've improved, I've made new and increased the value of the property by putting these superior materials in. But if I don't use superior materials, say for example, well, then maybe I get away with repair. And believe it or not, it's kind of stupid, but what you call it in your accounting actually makes a difference. So if you were to get audited and the IRS was looking at your rental property accounting, and you had originally put everything under improvements, and then you made a journal entry to reclassify it to repairs, like right at the end of the year, the IRS is going to use that against you, right? So what I tell my clients is, as far as your accounting, everything's a repair. Let me decide later on what's an improvement, because it going the opposite way doesn't hurt you. But if you do it, if you make I have clients who put $10 of materials under improvements. I'm like, what are you doing? Go back and change that. I don't want to. Well, can't you just make an entry? Yeah, I could, but that's going to hurt you, maybe. So swap that out and do it the right way. So a lot of it, especially with your clients and with yourselves, if you're doing this, a lot of it comes down to record keeping. and being a really good record keeper. All tax strategy is based on good record keeping. So the better the record keeping you have, the easier it is for me to help you, help the client, develop the strategies that are going to fit their scenario. And that's another really important point, which is everybody's different. All of the 5 of us in this room are all have different scenarios, right? We have different income, different marital statuses, different, goals, whatever, different amount of properties we own, different incomes. So when I look at somebody's situation, I look specifically at their situation and then match the strategies that'll work for them, because the strategies that work for me might not work for Dave, might not work for you, so you have all of these different scenarios. So it's all tailored. It's not a one size fits all kind of thing. Everything we do is tailored before you're into this client's specific situation. And because you don't want to, for example, you don't want to do a cost segregation study for somebody who's a passive investor who's not going to be able to deduct it. They're going to pay $10,000 for the study and they're getting zero deduction. So then it becomes stupid to do it. Or hey, my goal is to sell the property next year. Well, then why are you going to take all this depreciation in year 1 that you're going to have to recapture in year 2? We're only going to do the study if your holding period is at least 5 years. So something along those lines. A lot of what we talk about too, so think about when you're working with clients where you're going to sell properties, right? What's the gain, right? A lot of clients have no idea when they go to sell a property, what's their gain? They think, oh well, I owe 290 and I'm only going to sell it for 300, so my gain is 10. That's not how it works. Just because that's the only cash you're getting, right? That's not what your gain is. Your gain is a function of what you purchased it for, how much money you've put into it as far as improvements that you've put in, and how far down you've depreciated it. So you could have a property that somebody paid $1 million for 30 years ago. The cost basis could be 0. When they go to sell that property for $2 million now, they've got a $2 million gain. Even if they've got a $1,995,000 mortgage on it, they're going to get $5,000 at closing. They still have a $2 million gain. So, you have to talk with these folks and try to figure out, hey, first of all, what's the gain? Once you know the gain, then you can determine whether or not there's good strategies for them to defer the gain. The best strategy that we have out there right now is the 1031 exchange. So do you guys know how the exchange works? Pretty much? Yeah? Okay. I mean, the only real complicated factor about it is that you have to go out and find another property that is equal or greater than what you sold the other property for. So if you sell a $2 million property or a $1 million property, you got to go out and find another $1 million property. In this environment, that has gotten a lot harder to do. One that makes sense, one that you're not buying at a 3.5 cap rate, which is just some of the what people want for properties these days is kind of borderline ridiculous, and you wonder when that's going to break. But as long as people are buying them at that, it's not going to break. There's more demand than there is supply at this point, so that's going to create higher pricing. So that's the real downside of doing the exchange. Typically, you sell the property, you have 45 days to identify a new property, and you have 180 days to close on it. Okay, so what I tell people is, look, if I were you and maybe I didn't like this property, or if I found a property that I found a great deal and I didn't know how to fund it, and I had these other properties that I owned, right? Now that's a great opportunity, say, well, look, I just found this new property and it's a great deal and I'm going to make twice as much cash flow on it than I'm making on that one over there. So, well, now I already know I can sell that one over there in this market at a 4 cap rate, probably with a couple of days worth of sales activity, right? Throw it up on on the LoopNet or something, and somebody's going to buy this commercial building or whatever. So so now I've actually got a strategy because I've already identified something that's better. Why would I even sell my property if I'm going to sell it and buy something that's not as good? Why am I going to sell a property that I'm making 12% on to buy a property that I'm making 5% on? You know, and a lot of times, you might have clients that you ask them that question, they're like, I'm bored. I've owned that property a while. You know, doesn't thrill me anymore, right? I don't get jazzed by owning this property. And we're like, all right, well, you know what? It's still a business, right? Real estate investing has its sexy elements, but it's not supposed to be super exciting, right? I mean, it's you're yeah. Hopefully it's not exciting. You don't want it to be exciting because if it's exciting, if like you were talking about walking in and finding water everywhere, you don't want to be that excited. No, Mark was telling me a story today about, I was doing a podcast today, and the guy was, Mark from CT Rear was telling me that he went into one of his properties and the basement was full of water. And he was like, holy cow, what happened here, right? And then he realized that the pipes were gone. Over the weekend, he had gone away for the weekend. Over the weekend, somebody had broken in and literally stolen all the pipes, and he had water, and he thought he was, finishing the basement. He was creating, he put in an in-ground pool in the basement, So it's just, you don't want it to be that exciting. But so that's it's boring, but using those kind of strategies when you want to defer, is good if you can find the properties. And in a good market, you can really do really cool stuff with this. So I had a client who, over about a 10-year period, bought up a whole bunch of smaller units, right? And at that time, you could buy these like little units, he was buying, ones and twos and whatever. And not here, but somewhere where you could pick them up for $40,000, $50,000, $60,000 a piece. And so he had about $500,000 in cost basis, and he had, quite a few rental properties. And he decided he was tired of managing them and he wanted to do something bigger. And this was in a time of a somewhat rising market. So he found one investor who wanted to buy all of his properties. So he sold them all kind of as a group. And he went and he took it, and he went and he bought a shopping center. That was it was on the main road, but it was a little down on its luck, and some of the tenants had left and it was a little run down. And he spent the next year and a half fixing the shopping center up. So he did an exchange so he sold his $500,000 portfolio for $1 million. So he had a $500,000 gain, and he didn't want to pay the taxes. So he went and bought this $2 million shopping center. And he was able to use the exchange to defer that $500,000 gain. So now, next year or so, he's fixing up this property. And, after a year and a half, he's got it all fixed up. New tenants in there, looking good. Market's risen even more. Somebody offers him $3.5 million for it, right? Wow, awesome, right? I'm going to sell it. What's the gain? Well, right now the gain is, the $1 million that you made, the $500,000 you made on the other portfolio sale, and about $1 million that you're going to make on this one. So now you've got $1.5 million gain. Well, I don't want to pay taxes on $1 million. I'm going to do another exchange. Awesome. So in this scenario, he went and he bought 6 buildings in Texas that had auto zones in them, right? And so AutoZone at the time was a high credit tenant, triple net lease. And now all he does, he got a mortgage on it, and now all he does is collect a check every month because there's nothing for him to do. There's no management. There's nothing, right? So he's like, awesome. So I'm getting this, $40,000 a month net, after, and so he just wrote that out. So I was talking to him, a while back or whatever, and he's like, I'm never going to sell these properties. I'm going to give them my son. My son's going to inherit these properties when I die. Awesome. You know what's going to happen when he does? Whatever, when you die, whatever the value of those properties is, you're going to get a step up in basis. So if they're worth 10 million, hopefully 40 years from now when you die, right? Your son will get that immediate step up in basis up to 10 million, and he can turn around and sell them the next day for $10 million and not pay a dime in taxes. So you went from having a $500,000 portfolio to building it up to, over a period of time, building it up to wherever it ends up, and nobody ever paid a dime in capital gains tax because they use the exchange and then use the estate tax rules to sell the properties. Now, if that same thing, and that this was in Florida. Florida doesn't have doesn't have a sales level estate tax. The state of Connecticut has an estate tax that runs somewhere around, the limit is somewhere around $2.5–3 million. So in that case, he would have had, if he did that in the state of Connecticut, he would have had to give the state of Connecticut some tax, but he wouldn't have to give the IRS any estate tax on that because the limit is much higher. So, great strategy for building an incredible amount of wealth in a reasonable period of time, So there's only 3 other strategies now that you can use. One of them is literally pay the tax. And believe it or not, sometimes I actually tell people, pay the tax. If that's your scenario, if you don't want to buy another property, right? If you don't want to hold the mortgage, right? Because we'll talk about some of these other strategies. If you don't want to, the new thing is opportunity zones, right? So if you don't want to do an opportunity zone investment, well then you don't have any choice. Pay the tax, right? And so that's sometimes a viable scenario. Sometimes it's not. Sometimes, like I was involved in an exchange I was involved in a sale one time where they wanted to do an exchange, but it was a father and son, and they owned this property that they had owned forever, and they had like a $2 or $3 million capital gain on it, right? And it was going to cost. They owned it 50-50, and it was going to cost this guy, the son, like $400,000 in taxes to just pay the tax. So this other CPA actually called me, and he's like, "This is the scenario. What should we do?" Right? And I said, "Well, no brainer. Do an exchange." Right? He won't do an exchange. He hates his father. Doesn't want to do another deal with his father. He'd rather pay the $400,000 in taxes than own another building with his father. I'm like, what? That's insane. How much could you have to hate somebody to not, to want to pay $400,000, right? That's just, that's bizarre. So we kind of looked at a few things, and it's possible to take, so in this case, it was in an LLC. So what the rules say is if you sell in an LLC, you have to buy in an LLC, and that's why he was going to have to do business with his father. But so what we were able to do was get it so that they were able to retitle the property from LLC, take it out of the LLC, and title it tenants in common, so that each of them own a 50% share tenants in common. And when you do that, okay, I'm not a lawyer or anything, but when you do that, you're able to sell your interest. And so one guy could do whatever he wants with his. The one guy could have paid the tax, and the other guy could do an exchange. Or they could both do separate exchanges, right? So in this case, the one guy, my client, was he actually took his half, sold his half, and he went and did an exchange. We don't never know what the father did because we never found out what the father did with his, but we were able to work that out, So it's always good to look at all the different angles of what's possible for your clients, right? And what's possible for yourself, because there's usually is a way to work it around. If you get into a situation where they just don't want to do that, or you can't, you're not going to be able to find a replacement property, then it's possible to defer the taxes over you still pay the tax, but you can defer paying them using what's called an installment sale. And that's when somebody literally holds the mortgage instead of the client going to you saying getting the mortgage. The seller holds the mortgage for the buyer. And it's a great strategy for people who you see this a lot with older people, right? Who own these buildings and stuff. They've owned them for this property's been in my family forever, right? Well, it's been depreciated forever too, right? And so you got zero basis, maybe it's $1 million property. Hey, I'll sell it to you, but I don't want to pay the tax, so I'll sell it. You give me $100,000 down, enough money to make me feel comfortable that you're not going to walk away from it someday, and then I'll give you a $900,000 mortgage for 20 years, right? And so now I'm going to pay tax on the 100 in the first year, right? And every dollar of principal that I get, right? That's what I'm going to pay tax on. Year 2, I'm going to pay tax on all the principal I get on the mortgage. Year 3, year 4, year 5. So I'm spreading the tax. Let's say there was a $200,000 tax on that. I'm spreading the $200,000 tax over 20 years instead of paying it in year 1. That's a huge advantage, right? Not only that, because in year one, where I had that $200,000 gain, if I had another $200,000 worth of income, say from my another business or whatever, I'm paying tax at the highest rate, right? Not, I'm still paying tax on that building sale at the capital gains rate of 15%, but my total income, my earned income now is going to be taxed at a higher rate because I've pushed my earned income up into a higher bracket, right? So what ends up happening is if you do that, you spread it out, and now you always stay in the lower bracket, right? Makes sense. Most of the time, attorneys blow those deals up, right? They're going to explain to their client why that's a horrible idea and blah, 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 and but it's a good tax strategy, so if you can do it. Now, the reason why you may want to understand that also is because if you want to buy a property from somebody who's in that exact same scenario and you can explain that strategy to them, right? Well, maybe you can buy $1 million property for $100,000 down and get a 20-year mortgage for $900,000. Now, no offense, I never have to go and see you, right? I don't even have to have credit, really. Maybe I'm a guy with a 340 FICO score and 100 grand, right? And I can actually get into the rental property business, right? Because no bank is going to tell me no. Right? I'm going to do seller, and people do that, not all the time, but those deals are out there, right? And if you know how to explain it, you've got a lot better chance of buying it than if you don't know how to explain it, or you don't, it never even comes up because you don't understand the mechanics of it, so it's hard to explain. And most of the time, not only are you going to explain it to the person, the seller, but you're going to explain it to the seller's lawyer and the seller's CPA, right? And you're going to have to. Those are the two guys. Well, if my CPA says it's okay, I'll do it. Or if my lawyer says it's okay, I'll do it. And that's where typically having enough down payment money comes in, having a good reputation, maybe within the community as a landlord, or somebody who's managed a lot of properties or something. Look, I'm not a fly-by-night guy. I'm somebody who's been in the business. I've been in the real estate business for 20 years. I sell blank number of properties a year and whatever. So now, so there may be something you have to build in, sort of a credibility factor there, right? So that's basically kind of usually where I come to an end of this kind of a presentation, and I'm happy to answer any of your questions now if you want, but go ahead.
As a real estate agent, what would you say, I guess, is a good way to track your expenses, software programs that you may
Sure.
have in mind?
Yeah, it all depends on how much activity you really have, right? But so there's nothing wrong with using, and I would tell you this, whatever you're the most comfortable using, that's what I would use, right? So if I was more comfortable with a spreadsheet than I was with QuickBooks, I would use a spreadsheet because it would be very easy for me to say, yeah, use QuickBooks, right? And all you have to do is set up one account. So if I was doing that, what I would do is I would have my real estate agent account, right? And the only thing that would go into my real estate agent account is real estate agent income, commissions, whatever else, whatever other little income you can make doing different things. And the only thing that would come out of it are my real estate related expenses. Because if I did that and I did absolutely nothing else as far as bookkeeping, I could turn my bank statements over to a bookkeeper, and in a few hours I could know my profit and loss, right? Because everything, no matter what, everything's there. And I would have a debit card that I use for everything. I wouldn't use cash for anything. Because if I go out and I go to lunch every day with somebody and I buy them lunch with my debit card, well, every one of those transactions is on my bank statement. If I pay cash, none of them are on my bank statement, right? If I have a credit card that I use, I would try my best to designate one credit card. And then I would pay that credit card bill out of that checking account. Worst case scenario, you turn over all your credit card bills, all of your bank statements to a bookkeeper, and voila, it's done. You can do the exact same thing yourself using either QuickBooks or a spreadsheet or There are apps now that you can load your receipts into, and it does that. So there's all kinds of stuff. I would say the best one to use is the one you're the most comfortable with, because that's the one you're not going to battle yourself over using, right?
I think the biggest pain in the butt is, your expense for driving. It goes by the mileage.
Miles, right? And typically, look, you can reduce that to being a lot less of a pain in the ass just by using a smartphone app, right? Because there's smartphone apps now that track miles, and you literally you get in the car, you press the button, go. You get to where you're going, you press the button, stop, right? There's some way of coding it either as B for business or P for personal, and at the end of the year, if you do that every time you get in and out of the car, at the end of the year, you can download the report into Excel, and it literally add it up, and boom, there's your miles for the year. You're typically going to always be better off tracking your miles than you are actual costs, because the way they do the mileage calculation is they take everything into account, right? So you almost never, and I do this, all day, literally with clients when I do their returns, looking at actual costs versus miles. The only time you ever get somebody who has a lot of more actual costs is when they really have like a major repair. Like I had a friend of mine literally drove his car into a huge puddle during a rainstorm and drowned his engine, essentially, right? And he had to have a complete engine replacement. Well, that year, his actual was higher than his miles, right? Because he
Switch back and forth.
you can switch back and forth every year. You're not locked into anything. But typically, the miles are always going to be better unless you really kill your car. And those apps are great. I love when people hand me those reports, because one, it tells me that they're good record keepers and that they're tracking this stuff, right? So now that makes it a lot easier to be a little more aggressive, right? So Tuesday night, I'm in a room with 40 or 50 investors, and somebody asked me, you seem you seem like you take an aggressive approach to taxes. Why are so many accountants conservative? And I said to the guy, I said, well, a lot of accountants are conservative because they know you guys are awful record keepers, and everybody laughed, but that's the truth, it's if I know you're an awful record keeper, I don't want to carry your box of receipts down to New Haven to the IRS's lady's office, right? To look, because I know I'm going to lose. But if I know you've got good, detailed bookkeeping, that you ran all your expenses through one account, and you've got a mileage app or whatever, if you have a problem, now that good record keeping allows us to be a little bit more aggressive, because we know you're right? We know if something happens, all we have to do, because if I walk into the IRS lady's office in New Haven with a carefully calculated spreadsheet that you use from your app, and not only does it make your job, you might be in and out of there in 10 minutes. Literally, she might look at yourself and go, okay, this guy and if you walk into a box, she's like, cancel my next meeting. I'll be here a few hours, right? And you're in for it. You're walking out of there with a bill, or you could do good record keeping and walk out of there in 10 minutes, or you could do bad bookkeeping and walk out of there 2 hours with a bill, or 5 hours, or whatever it takes for them to literally pick through your stuff. So it's good business, and the people who are not good record keepers are certainly leaving money on the table. Because if you told me, yeah, my real estate, I pay some expenses from this card. I've got 2 or 3 different bank accounts I pay expenses out of. I have no idea what, blah, blah, blah. And you hand, and don't laugh. A lot of people hand me, are telling me all this stuff. And I'm telling you, you're missing stuff. Oh, I pay for things for cash all the time. You're missing stuff. There's no way you're catching all of this stuff. Think of like contractors are the best for this, Think of the entire dashboard of a pickup truck, of a contractor's pickup truck is lined with their receipts, right? And they like, oh, I've got to go to my accountant, right? Throw it all in, they come in like with an armful of stuff, right? And you just know that they missed some stuff, right? Not everything made it to the dashboard, some of it's probably bundled up underneath the seat or something. That might be a $10,000 invoice under the seat. Who the hell knows? So it pays to be organized. And if that's not your natural tendency, then just hire somebody who is organized to do it, because you can get bookkeeping done for $25 an hour, $20 an hour. I mean, we charge $50 an hour, but we're a CPA firm, so we have a little higher end version of it. And our people, I hire good people, so they're typically faster. But out in the real world, hey, $20 an hour, you can get somebody organized, comes in, organizes your stuff, is happy to have the work, right? So.
All right, Ted, I'm a W-2 employee. I'm
Okay.
100% commission, but W-2.
Right.
I don't have the deductibility that you guys have.
Right.
Any recommendations?
Well, you see, unfortunately, you're in the worst of all possible worlds,
Yeah.
right? Because the system, especially the new tax laws, the W-2 guy got screwed.
Yeah.
Because especially the high income earning W-2 guy who maybe lives, who's going to get capped out on his itemized deductions, for real estate taxes and state income tax, those people got slammed. The only thing I can tell you is to try to, there's a few things you can do. The biggest one probably is defer as much as you can afford to defer into your retirement account. So if you look at your scenario and you say, this is how much money I make, but I only live on this much of it, defer as much of it as you possibly can into some sort of retirement plan, because that's really one of the very few strategies that exist for you.
Can he write off, so in his example, he actually rents office space right around the corner. So can he write those things off for himself? I mean, are those deductible?
Not as a W-2 employee. All of that stuff went away with the 2000. So you used to have this thing called unreimbursed employee business expenses, right? And prior to 2018, you would have been able to do that. You would have been able to say on your Schedule A, your itemized deduction form, you could have deducted unreimbursed employee business expenses. So you would have been able to do the same thing with the miles that we were just talking about, right? And an office and blah blah blah, right? And but now
18 grand, 24 grand?
what's that?
The cap deduction. Single 18,000, right?
Well, they're giving it to you, yeah, right. So you can itemize over that, but there's only so many things you can itemize at this point, right? Because they took away the employee business expense. So now you're pretty much stuck with medical, which is very hard to get over the medical cap. So medical doesn't even exist. You're capped on your real estate and state taxes at 10 grand. Your mortgage, so you have your mortgage interest, your 10 grand for taxes, your mortgage interest, and your charitable contributions. And let's say you're married, all of those things have to be over $24,000 in order for them to even matter. So if you're capped at 10 and your mortgage interest is 10 and you say your charitable contributions are 2 and you're at 22, well, you're getting 24 anyway. So, and I hate to say this because maybe some of you guys do this, but I have some clients that tithe to their churches, right? And so they're like, oh, well, I'm getting that big deduction for tithing to my church. No, you're not anymore. Because, you remember when, so you're getting $24,000 automatically, right? You would get that whether you did nothing, right? You could rent a house and get that, okay? So your mortgage interest is $5,000, your real estate taxes, and typically the poorer the person is, the more they're tithing, right? So they're not going to have high mortgage interest, they're not going to have high real estate tax or whatever. They're never getting over that 24. So I tell them, look, I'm not going to tell you what to do with your money. Feel free to give all the money to your church that you want to. Just know that there's no tax benefit to it. You're doing it out of the goodness of your heart because you want to be a charitable person. You want to support the organization you belong to. But there is no longer any tax deductibility to that. And that's what sucks about it. So to completely
I
answer
set
your
up an
question.
LLC last year, but
Now you gotta pay tax on plastic bags and groceries.
Right. Yeah. Exactly. Well, so there's another strategy. So think about it from this standpoint, right? What can I do? What can I do to save money? Well, I could set up another business, right? And are you married?
no.
Okay, so you set up an LLC, and let's say you had something that you could turn into a business, right? As long as you're making a little bit of money, that's where you could sometimes you can allocate some of the things that, so people, a lot of people, and I'm not telling you to do this, by the way, but I have some clients that set up these like MLMs. You know, they get involved with selling, you know, skincare products or whatever, right? And the reason they do that is not because they want to be out selling skincare products or because they love it. It's because they can, because what we do is we teach them how to convert things that they're already paying for, right, that they're not getting any tax deductibility for. We're going to now teach them how to make those things tax deductible. Okay, so you can pick up, you know, $5,000 or $3,000 of income by selling Kivana skincare products, but you can take a $10,000 deduction for your cell phone, your internet, you know, a portion of the real estate taxes and mortgage interest that you can't, that you're already getting $24,000 or $18,000 for. You know, all those things become home office expenses now, right? Your utilities, you know, all of that, and all of that becomes legitimate business expenses for this business that you're never going to make any money on, right? And people will come back and they'll say, well, yeah, but how about like, you know, hobby loss rules and stuff that say you can't have a loss for more than a certain period of time. Well, that's not necessarily true. You can't deduct losses from a business that you've made zero income on for more than 3 years. But you know, look at some of the big tech companies, they lose money every year, right? You know, so you don't, as long as you have revenue and you're operating it as a business, you can show that, hey, I am pitching skincare products and I'm having little seminars and I'm doing this or whatever. You know, and again, I'm not telling you to, I'm telling you to find something, if you're interested in that, find something that you're super interested in, right? And turn that into a business. You know, it could be literally anything. I have a guy who races cars, and he takes buku. I mean, he's going to get audited one of these days, but he takes buku, you know, deductions on his auto racing. He loses money every year. Now, he actually does win some races and does declare some prize money, right? You know, so, you know, he so far he's been okay with doing that. But whatever you feel like you have a passion for, that you do a lot of, you know, and if you can figure out a way to turn it into a business, then that may be a good way to help offset some of that earned income. Yeah. Real estate investing, you know, another way. It all depends on what your income is, you know, but real estate investing has some of it, especially the you know, not so much maybe being a landlord, but flipping properties. You can probably make some money and maybe even show a loss, depending on. The worst case scenario is you end up like what I was doing, where I was actually flipping houses as a hobby, and I was making money, you know, and I was like, oh, okay, great, you know, awesome, you know, yeah, this is terrible. Now I got to pay taxes, but who cares, right? Because you're making the money, right? And you know, you're in an industry that when things do get hot, you know, you could make rock star money, right? So.
I just had a question. You started going, and I kind of lost on my notes. You mentioned there were 3 classes of investors. It was passive, active, and what was it?
And real estate professional.
And just a real estate professional.
Yeah, and real estate professionals are the people who spend more than 750 hours a year in a real estate related activity and own rental properties that now they can take unlimited losses against their actual rental properties. Now,
50%.
and there's a 50%, 750 hours and over 50% of what you do. But if all you do is real estate related activities, right? So if I'm a broker, property manager, landlord, rehabber, right? Did I just cover you?
Yeah.
Right?
Right. You're looking right at me.
Right? Yeah. So if I've got these 4 things going on, right? So that's all I do. Every one of those things individually would qualify, right? Together. So what the IRS would say, though, is you need to make an election that says all of these things, I'm electing them to make them one thing. for taxation purposes, right? They could be 4 different LLCs, they could be whatever, but for IRS purposes, they're one real estate business. Because the IRS can say, well, wait a second, you needed 750 hours for one, 750 for the other. So if you don't make that election to consolidate them, then you end up having, in theory, a landlord could have to put in 750 hours on each property. So you make the election to consolidate it as one business for the purposes of taking the professional status. But yeah, at that point, there's no limit to what kind of rental losses you can take. It's probably the best for real estate professionals. It's awesome. I mean, I know guys who, when they buy a new property, literally, offset, half to 3/4 of their commissions in a year. A guy I know made, a commercial guy I know, bought an apartment building and wiped out $300,000 worth of commission income he made one year, just on that bonus depreciation. So,
Cool.
all right, guys. Well, thank you so much, man. I
What's that book
appreciate
that
it.
you